Welcome to our deep dive on mastering the Backdoor Roth IRA. In this video, we will cover how high earners can legally contribute to a Roth IRA using the backdoor strategy, how to avoid the pro rata rule trap, how to use spousal contributions to double savings, and how to properly file IRS Form 8606 to remain compliant. Let's begin with a quick overview of what we'll cover. Here is the agenda. We will start by explaining what a backdoor Roth IRA is. Next, we will identify who should use it. Then, we will discuss contribution limits and spousal contribution power. After that, we will walk through the two-step conversion process, examine the pro rata rule trap and how to avoid it, and review Form 8606 compliance. We will also share an annual timeline and best practices, provide an action checklist, and include a couple of quick quizzes to reinforce learning. First, who is this for? If your adjusted gross income exceeds the IRS thresholds for direct Roth IRA contributions, you cannot contribute directly to a Roth IRA. However, the backdoor Roth IRA strategy allows you to contribute indirectly by making a non-deductible traditional IRA contribution and then converting it to a Roth IRA. This is fully legal and commonly used by high earners. Now let's clarify why this is powerful. Let's discuss why the backdoor Roth path is attractive. Roth IRAs allow investment growth to be tax-free as long as you satisfy the qualified distribution rules. There are no required minimum distributions for the original account owner, providing more flexibility in retirement. Roth funds also provide tax diversification compared to pre-tax accounts, which can help manage future tax rate uncertainty. Finally, Roth assets can be advantageous in estate planning because beneficiaries can inherit tax-free distributions subject to applicable distribution rules. Next, let's examine contribution limits and the spousal contribution opportunity. Now moving on to limits and spousal power. The IRA contribution limit applies per person. For example, in 2025, the contribution limit is cited here as $7,000 for those under age 50, with potential catch-up contributions for those age 50 and older. Because the limit is per person, married couples filing jointly can effectively double their contributions if both spouses contribute. Even if one spouse has little or no earned income, the Spousal IRA rule allows a contribution based on the working spouse's income as long as the couple files jointly. Importantly, each spouse must complete their own backdoor Roth conversion separately, meaning 2 separate traditional IRAs and 2 separate Roth conversions. Next, we will walk through the exact 2-step process. Here is the 2-step conversion flow. Step 1. Make a non-deductible contribution to a traditional IRA. Step 2. Convert the entire amount to a Roth IRA promptly. The timing is often immediate or shortly thereafter to minimize any taxable gains before conversion. Remember, each spouse performs this sequence independently in their own accounts. Throughout, ensure that you keep detailed records because you will need them for Form 8606 reporting. Before converting, however, there is a critical trap to avoid, which we will cover next. Let's translate the process into actionable steps. First, open a traditional IRA for each person who will contribute. Second, contribute up to the annual limit and mark it as a non-deductible contribution. Third, consider leaving the funds in cash to avoid short-term gains prior to conversion. Fourth, verify that all pre-tax IRA balances across traditional, rollover, SEP, and simple IRAs will be zero by December 31st to avoid the pro rata rule. Fifth, initiate the Roth conversion for the full contribution amount. Sixth, ensure a Roth IRA account exists to receive the conversion. Seventh, document your contribution and conversion dates and keep the confirmations for your records. Finally, file IRS Form 8606 for each individual who made a non-deductible contribution and conversion. Next, let's examine the pro rata rule in detail. Now, regarding the pro rata rule, the IRS aggregates all of your IRAs, including traditional, rollover, SEP, and simple IRAs, when calculating the taxable portion of any Roth conversion. The critical snapshot date is December 31st of the tax year. If you have any pre-tax balances in these IRA accounts on that date, a portion of your conversion will be taxable, reducing or eliminating the intended benefit. To avoid this, many people roll their pre-tax IRA funds into an active employer 401k, if allowed, before year-end. The goal is to have a zero pre-tax IRA balance on December 31st. Next, we will compare strategies to avoid or handle this rule. When you hold pre-tax IRA money, you generally face two paths. On the left, you can roll your pre-tax IRA into your active employer 401k, if allowed. The pros are that it preserves the tax-free nature of your backdoor conversion and can be executed relatively quickly. The cons include potential limitations or higher fees in the 401k plan. On the right, you can proceed with the conversion and pay taxes based on the pro rata calculation. The pros are simplicity and not needing to coordinate with a plan. The cons are that the taxable portion could be substantial, undermining the strategy. It is best to compare both by modeling the near-term tax cost against the long-term tax-free growth benefits. Next, let's cover the crucial compliance form. Next, we must emphasize IRS Form 8606. Every individual who makes a non-deductible contribution to a traditional IRA and converts must file Form 8606 with their tax return. This form records your after-tax basis and prevents double taxation of the same dollars when distributions occur later. Keep copies indefinitely, because basis tracking carries forward each year. Inaccurate or missing Form 8606 filings are a common source of IRS correspondence, so accuracy is crucial. Now, let's visualize a practical annual timeline to keep everything on track. This timeline shows a practical cadence. From January through April, you can make your non-deductible contribution for the current tax year, though you can contribute up to the tax filing deadline for the prior year depending on the timing. Immediately or soon after contributing, initiate your Roth conversion to limit any taxable gains. Before December 31st, ensure all pre-tax IRA balances are fully rolled into a qualified 401k if applicable, so that your pro-rata snapshot is clean. By the next year's tax day, typically in mid-April, file your tax return with Form 8606 included. Throughout the year, document contributions, conversions, and rollovers, and monitor account balances to remain compliant. Next, let's solidify the process with a concise checklist you can reference. Here is a quick checklist. First, confirm that your income level blocks a direct Roth contribution. Second, open a traditional IRA for each spouse. Third, contribute a non-deductible amount using the current year's limit. Fourth, verify that all pre-tax IRA balances will be zero by December 31st. Fifth, convert the full contribution to a Roth IRA. Sixth, record the dates and amounts and save confirmations. Seventh, file Form 8606 for each person. Finally, invest according to your target asset allocation. Now let's test your understanding with a quick quiz. Quiz question: which date matters most for the pro rata rule when assessing pre-tax IRA balances? Option A, the day you convert. Option B, December 31st of the tax year. Option C, April 15th, tax day. Option D, the day you contribute. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, December 31st of the tax year. The IRS uses the year-end snapshot of all your IRA balances to calculate the taxable portion of the conversion under the pro rata rule. Keeping those pre-tax IRA balances at zero on December 31st is essential to preserve a tax-free backdoor conversion. Second quiz question: can a non-working spouse contribute via the backdoor Roth if filing jointly? Option A, no, only the spouse with earned income can contribute. Option B, yes, under the Spousal IRA rule, each spouse can contribute and convert separately. Option C, only if both spouses are over 50. Option D, only if you open a joint IRA account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Under the Spousal IRA rule, when you file jointly, the non-working spouse can make an IRA contribution based on the working spouse's earned income. Each spouse must execute a separate backdoor conversion in their own accounts. This effectively doubles the household's annual Roth contributions. This table illustrates common scenarios. In Scenario A, with zero pre-tax IRA balance on December 31st, converting the full amount typically results in no tax due on the conversion. In Scenario B, with a $45,000 pre-tax balance, Converting anyway will trigger pro-rata taxation. In scenario C, rolling the pre-tax amount into a 401k to reach a zero pre-tax balance and then converting preserves the tax-free conversion benefit. In scenario D, both spouses maintain zero pre-tax balances and each completes a conversion, doubling the household Roth funding. Here are the key takeaways. The backdoor Roth involves funding a non-deductible traditional IRA and then converting promptly to a Roth IRA. The contribution limit is per person, so spouses can double contributions when filing jointly. The pro-rata rule uses December 31st IRA balances, so aim for zero pre-tax balances. Rolling pre-tax IRA balances into a 401k can clear the path. Finally, filing Form 8606 is mandatory for accurate basis tracking and to avoid double taxation. To wrap up, you now understand how to execute the backdoor Roth and how to avoid common pitfalls. Set reminders for contributions and conversions, and make sure to check that pre-tax IRA balances are zero by December 31st. Coordinate with your employer's plan administrator if you plan to roll pre-tax IRA assets into your 401k. Keep thorough documentation and file Form 8606 in any year you make non-deductible contributions or conversions. Next, we will include a brief but important disclaimer. Disclaimer: this content is for educational purposes only and does not constitute tax, legal, or investment advice. IRS rules, thresholds, and contribution limits change over time. You should consult a qualified tax professional or financial advisor regarding your specific circumstances before taking action. Thank you for watching. If you found this helpful, please like the video, share it with someone who would benefit, and subscribe for more content on tax-efficient investing. Leave your questions or experiences with the backdoor Roth in the comments. We'd love to hear from you.